If you've convinced yourself out of a Roth conversion because you don't have cash sitting outside the IRA to cover the tax, give me a few minutes here because I think you were talked out of it for a bad reason. That rule that you're following, the one that says never convert unless you can pay the tax with outside money, started out as good advice, and somewhere along the way it hardened into law. And it's costing you far more than it ever saves you. So here's what I'm going to show you today. When you convert and withhold the tax straight out of the IRA, which is the thing everyone warns you never to do, you end up with the same spendable dollars you'd have otherwise if you never converted at all. And as long as you're at least 59 and a half years old, there's no penalty for doing it supposedly the wrong way either. Let me explain the logic of the advice to never withhold the tax from the IRA because it isn't coming from nowhere. Say you convert $150,000 and the tax on it comes out to 36,000. Now I want to be careful with that number because conversions that size typically don't sit politely inside one single tax bracket. It climbs through a few of them, which means dollars are taxed differently because of the progressive tax system in the US. So 36,000 isn't one rate multiplied by the whole conversion. It's just what that finished bill came to, and it happens to work out to right around 24% of what you moved once you blended it all together in this scenario. Every percentage I use in this video is that kind of number, the effective rate on the money we're talking about, because that's the only version that lets you compare today against 20 years from now, honestly. So if you withhold that tax from the conversion itself, 36,000 goes to the IRS and 114,000 ends up in the Roth IRA. If you write a check for the 36,000 out of savings instead, the whole 150,000 is invested in the Roth. In this scenario, you put $36,000 more into an account that never gets taxed again, which after 20 years of growth is real money. Now, withholding does not mean you converted 114,000 and get taxed on 114,000. You pulled $150,000 out of that IRA and the IRS taxes all 150,000 of it because the piece you withheld is a distribution you took that happened to go straight to the IRS rather than to your bank account. Your tax bill is $36,000 either way, so nothing about withholding lowers what you owe or delays it to another year. The only thing you were deciding here is which account that $36,000 comes out of. So when someone tells you to pay from outside if you can, they're right. And I tell you the exact same thing every single time. If you have cash, earning very little in a savings account, sending it to the IRS so a bigger balance can sit inside a Roth is a pretty good trade. Where that advice kind of goes sideways is that it assumes the outside money is sitting there doing nothing and that you won't miss it. Sometimes that's exactly right. And when it is, you absolutely should use it. But for a lot of retirees, that cash is also the reserve, the money that keeps them from having to sell something at a bad moment and handing it to the IRS to protect a conversion can leave you exposed in a way that costs you a whole heck of a lot more later than the conversion ever saved you in the first place. So the question isn't whether you technically have the cash somewhere, it's whether that cash already has a job and a purpose. But the reason withholding tax from the IRA feels so painful is because the psychology of this situation is doing more damage than the math. When you log in and your account says $500,000, your brain reads that as $500,000 of your money because your name is on it, you funded it out of every paycheck, and you watched it grow. But that's a gross number. It's not a net number. Think about the first pay stub you ever got, where there's a number at the top and then there's a number at the bottom. And that number at the bottom is the one that shows up at your bank account. And nobody who's been working more than a few weeks ever confuses the two. You never grieved the difference because you understood the top number was never yours to keep. A traditional IRA statement is a pay stub that hasn't run through payroll yet because some percentage of that balance belongs to the IRS. You don't know the exact percentage, which is the whole problem we're trying to solve here, but you know for certain it isn't zero. So that money is sitting in an account with your name on it, and part of it isn't yours and never was. Hopefully, that alone can change your mindset about converting and withholding the tax. You didn't lose $36,000 of your money. By withholding the tax, you settled a bill you were always going to pay using the exact portion of the account that was always going to be handed over anyway. The account got smaller, and the liability sitting on top of it got smaller in the same instant because those two moved together. This reframe is only worth something if the numbers back it up. So here's an example. Two people each have $150,000 in a traditional IRA, and both have the same effective tax rate on that money at about 24%, whether it gets paid now or later. And I'm holding that 24% tax rate steady on purpose because it's the assumption most generous to the people telling you not to convert. The first person has cash sitting outside the account. So they convert the whole 150,000 and write the IRS a check for $36,000 out of saving. All $150,000 goes into the Roth, and 20 years later at 6% per year, that account is worth $481,000. Every dollar of it tax free. The second person converts the same $150,000 but withholds the tax. So 114,000 goes into the Roth and their 36,000 of savings stays right where it is. 20 years later, that Roth is about 366,000. Then let's say the $36,000 they never spent is invested in their brokerage account growing at that same 6%. So it's worth about 115,000. Let's add up what the second person is holding. They have roughly $402,000 that's tax-free, which is the Roth plus the original 36,000 and about $79,000 of long-term capital gains sitting on top of that, assuming there were no dividends or rebalancing or anything else along the way affecting those gains. So they aren't behind by $115,000 the way the scary version makes it sound. They're behind by whatever tax comes due on the $79,000 of gains. So if they're in the 15% long-term capital gains bracket, that works out to about $12,000. On a $481,000 outcome, we're talking about 2.5%. That's it. And if their income lands them in the 0% capital gains bracket, the difference between these two people is nothing at all because the two paths finish with an identical amount of tax-free dollars. Now, if you're sitting there thinking that your $36,000 would really be parked in savings, earning almost next to nothing, then the gap between these two people would be bigger rather than smaller. But hang on to that thought for a moment here because in a minute, you'll see it doesn't even touch the comparison this video is really about. The truth is, without a doubt, paying the conversion tax from outside money is the most effective way to do this. And I'm not going to pretend otherwise. But being the most effective way and being a mandatory requirement are two very different things. What I'm saying is we just spent all that time on what withholding costs compared to paying from outside, and it came out to 2.5%. But what if this 2.5% debate ultimately convinces you to skip the conversion entirely? Let's put a third person in the room. And we'll make this a fair fight by giving all three of them the same $36,000 in savings. So the only thing that changes between them is what they did with it. The first person spent theirs on the tax. The second kept theirs and withheld instead. And the third person kept theirs as well, but they never converted at all. And notice what that does. The only difference between the second person and the third person is the IRA. 20 years later, that third person's IRA has grown to the same $481,000, except they still owe tax on every dollar of it. At that same 24%, they net about $366,000, which is a dead tie with the person who converted and withheld. And there's a reason those two tie. When you leave the money in the IRA, the IRS's share grows right along with yours because their share was never a fixed $36,000 bill waiting on a shelf. It's a percentage, and a percentage rides the same 6% you do. So 20 years from now, their cut isn't $36,000 anymore. It's about $115,000, which means when you withheld that tax up front, you didn't take 20 years of growth away from yourself. You took it away from the IRS. But the third person is exposed to a danger that the other two aren't, and that's increasing tax rates. At an effective rate of 27% instead of 24%, they end up behind the person who converted and withheld by about $14,000. At 30%, they're behind by nearly 29,000, and at 33%, it's more than a $43,000 difference and still climbing. Essentially, for every 1% the effective rate climbs, it costs that third person about $4,800. 1% is $4,800. 2% is around 9,600, and 6% is close to 29,000. So if rates land exactly where they are today, the person who converted and withheld and the person who did nothing finish in the same place. Nobody won and nobody lost. But if the rate on that money ends up even 1% higher, the person who converted and withheld is ahead by $4,800. And the further the rate climbs, the further ahead they get. So converting and withholding didn't cost that person anything to find out. Their bad outcome was a tie. And that's what the rule never tells you, because the rule is busy comparing you to somebody who had $36,000 in cash sitting around, when the comparison that matters is you against a version of you who did nothing at all. Now, that only holds if your rate later isn't lower than it is today, and I'll come back to who that applies to here momentarily. But for most of the people we help plan their retirement, the rate on that money is heading up, and there are three separate reasons why. Right now, you might be in one of the lowest income years of your entire life, especially if you've stopped working and you haven't turned on Social Security yet. Then Social Security starts before required minimum distributions start and stack on top of that. And the required percentage increases every single year on RMDs, whether you need the money or not. And that right there is why holding the rate steady was so generous to the other side. The whole reason a conversion exists is that these two rates aren't the same. So the moment you let the later one drift up, even slightly, the tie stops being a tie. And if you're married, one of you is likely to outlive the other. And the year after that happens, the survivor is filing as a single person on close to the same household income. Now, some of you have heard there's a 2-year grace period where a widow or widower can keep the joint brackets. And there is, but it requires a dependent child living at home. So for most retirees whose kids are grown, it doesn't apply at all. You file jointly for the year your spouse died, and then you're single. The brackets narrow, Social Security thresholds tighten, and the Medicare surcharge lines drop. So the income barely moved and the rate went up. So let's follow that same IRA account one more step past the surviving spouse to whoever gets it after that. When your spouse inherits it, they can treat it as their own and keep taking distributions over their own lifetime. So the pace doesn't change much. When your children inherit it, they get an inherited IRA instead, and the rules there changed a few years back. The old approach, where they could stretch withdrawals across their own lifetime, is gone. So most non spouse beneficiaries now have 10 years to empty the account. And they're typically doing that in their 40s and 50s while they're earning the most they ever will. So the rate that finally gets applied to your IRA isn't yours at all, it's theirs. And that's often the biggest jump of the three. Any one of those three can push the rate on that money higher than it is today. And most retirees are looking at all three at once. Now, a couple things about withholding from the IRA that are critically important. The first is your age, and this is the one that can cost you real money. If you're under 59 and a half years old, don't withhold the tax from the IRA, because the IRS doesn't treat that withheld portion as part of the conversion. It treats it as a distribution you took and kept, which means that on top of the income tax you already owed on it, you're looking at a 10% early withdrawal penalty on that piece. Convert 150,000 at age 57, withhold $36,000 for taxes, and you just handed over an extra $3,600 you never had to pay. So if you're under 59 and a half years old, the tax either comes from outside money or the conversion waits entirely. The second is the one I promised to come back to. All of this runs on your rate later being higher than your rate is today. And if that isn't true for you, then none of this really applies. If you're still working and earning well, or a large pension is already filling your lower brackets, or you can see that you'll be in a lower bracket at 70 than you are right now, then converting isn't your move, and withholding the tax to do it just makes an expensive idea more expensive. And then there are cliffs, which aren't reasons to skip converting, but are good reasons to size it carefully. On a marketplace health plan before Medicare, the conversion counts as income, and it can cost you a real piece of your premium credits. And once you're on Medicare, crossing an income line by even a small amount raises your premiums for an entire year and shows up 2 years later. And depending on where you live, there may be state tax on the conversion too, though you would genuinely owe that on the distribution later anyway. None of these should be the ultimate factor on deciding if you should convert, but they have to be taken into consideration. And one last thing that works in favor of withholding is the IRS wants its money as income happens rather than all at once the following April. So paying out of savings when you file the next year can leave you owing a penalty for being late, even though you paid every dollar you owed. Withholding steps around that because a withholding from a retirement account gets credited as if it had been spread across the whole year, no matter which month you did it. So that was a tremendous amount of information. Let's summarize it. If you have cash outside the IRA that isn't doing anything else for you and spending it doesn't leave you short on the reserve you need to sleep well at night, then use it because that's the most effective version. But if that cash isn't there or it already has a job and you're past 59 and a half, then convert anyway and withhold the tax if it makes financial sense to do so. You're not choosing between a good outcome and a great one. You're choosing between a tie and a win. And the only way to lose that bet is if the tax rates on your money end up lower 20 years from now than they are today. If you're not sure whether that's you, that's the part worth getting help with because it depends on your pre tax balance, when you're claiming Social Security, whether there's a pension, and what the years before required distributions look like on paper. The only thing that I'd ask you not to do is what most people actually do, which is nothing at all, because they heard a rule once and they assumed it was written about them. And if you'd ever like a hand applying any of this to your own situation, you'll find a link right below in the description. Whenever you're ready, just remember the difference between worrying about retirement and enjoying it usually isn't more money. It's about taking the time to inspect what you already have and building a plan around it. As always, I appreciate you spending part of your day with me, and I'll see you in the next video.